Do you know what the funding cycle is? Do you know how your business is funded and how that cash flows through the funding cycle? This video is for you. In this video, we will discuss the funding cycle. We start by considering the ways in which your business can raise money, namely equity and debt. We then consider how that funding is invested in the business, and we also consider the different types of costs associated with the different types of funding. We then look at how the funding process and the investment process ties up with the operating process discussed previously with the cash conversion cycle, in order to present an overall cycle of cash flows. With that, let's dive into the presentation. In this presentation, we will discuss the funding cycle. We start by considering how financing can be raised. Firstly, our business can buy assets with an equity investment from shareholders. And when there is excess cash available, our business could also choose to buy back some of that equity from shareholders. Alternatively, our business could buy assets with a debt investment and incur liability to debt investors. Debt will typically have repayment terms which our business would need to comply with. Equity and debt investments and repayments represent cash flows from financing activities. How our business invests the cash raised represents cash flows from investing activities. Now that our business has raised financing and invested in assets, the expectation is to receive returns. This can be achieved through using the assets in our operating activities. As our income statement reports profits, our working capital moves through the cash conversion cycle, and we end up with cash flows from operating activities. Alternatively, we may use the financing raised to invest in financial instruments like stocks, bonds, or alternative assets. In this case, our expectation is to receive a return on investment over time relative to the capital invested and the risk taken. These cash flows represent cash flows from investing activities. Of course, the financing we have received from investors is not free. Over time, we will pay dividends to our equity investors, which is a cost of equity. Similarly, over time, we will pay interest to our debt investors, which is the cost of debt. These cash flows also represent cash flows from financing activities. We recall from video number 25 that we discussed the cash conversion cycle, which explained how cash flows through our working capital as part of our operating activities. We expand on the cash conversion cycle and consider how it fits into our overall funding cycle. We know that our cash conversion cycle was focused on our current assets and current liabilities. So we need to now consider our non-current assets, non-current liabilities, and equity. Assuming no dividends are paid, our profit and loss from our income statement is reinvested in the business. This is along with any new investment from shareholders. In addition, lenders could also invest debt into the business. All this cash is used to buy non-current assets, including property, plant and equipment, investment property, intangible assets, and financial instruments. Alternatively, the cash is invested in our working capital and makes its way through the cash conversion cycle. Now that we understand the funding cycle, we can think about some key ratios related to our liquidity, solvency, and financing. We start with the liquidity ratio, mentioned in previous videos. This ratio considers our business's ability to pay short-term debt obligations as they arise. It is calculated as current assets divided by current liabilities. Next, we consider the solvency ratio. This ratio considers our business's ability to meet its long-term debt obligations. It is calculated as total assets divided by total liabilities. Next, we look at our debt ratio. This ratio measures our total debt relative to total assets. It is calculated as total liabilities divided by total assets. Next, we look at our debt to equity ratio. This ratio measures our total debt relative to total equity. It is calculated as total liabilities divided by total equity. Our penultimate ratio is the interest coverage ratio. This ratio measures how easily our business can pay its interest bill. It is calculated as operating income divided by interest expense. Our final ratio is the debt service coverage ratio. This ratio measures how easily our business can pay its debt obligations. It is calculated as operating income divided by total debt service. In this video, we were introduced to the funding cycle. We considered the relationship between our long-term funding, how it is invested in assets, and the relative interaction with the cash conversion cycle discussed in video number 25. We also learned about 3 types of cash flows, namely cash flows from operating activities, cash flows from investing activities, and cash flows from financing activities. These concepts lay the foundation for us to understand another key financial statement, namely the cash flow statement. If you enjoyed this content, please like the video, subscribe to our channel, and click on the notification bell. It helps us grow the channel and bring more content to small and medium business owners and managers. Also, be sure to check the description below for any related product affiliate links. And finally, please comment on the video or click on our community tab to further interactions and updates.